Alright everyone, let's break down this trade, which in my view is a textbook short setup. Now, starting up here on the 2 minute time frame, we can see a steady and quite measured, I would say, at least initially, influx of sell orders, driving the price to new lows around the 21,170 level. After this 100-point decline, the market, as you can see, finds a base around here and begins to rebalance this immediate repricing move through these impulsive demand bars, mirroring this way the previous price action. This is then followed by a ranging phase lasting about an hour and a half. Now, typically prolonged sideways moves on low volume like this one, particularly after a steady drop, indicates, in my view, consolidation as opposed to downward pressure, as market makers and obviously other large players position themselves for the next move, and this subsequent 120-point spike clearly confirms this setup. Over here, as the price exhausts and then reverses at the 310 level and begins this sharp sell-off, it not only forms a clearly visible bearish order block, but also continues to puke lower in a pretty clear and sustained decline, signaling this way a strong bearish momentum and potential for further downside. And now my thinking here was that if the price retraces at some point back to this zone, it will most certainly act as a resistance area where shorts may re-enter the market, leading to another potential drop. In essence here, this bearish order block, unlike this block order at the 220 area, was for me a key level to watch for potential shorting opportunities. Why? Because judging by its massive impulsive supply bar, it reflected a solid supply zone and obviously a sharp disequilibrium between supply and demand, favoring this way the short side of the market. So at this point, the dynamic signaled to me that the best way to anticipate the next move was to wait for the market to rebalance after the 120-point demand surge. If it did, I thought I would look for a retracement into the 20-some point imbalance zone and below the base of the supply area. Otherwise, I thought that without a clear setup, there was no compelling reason to consider an entry. Obviously, it goes without saying that this is important, because if a retracement around the 247 level materialized, I thought it would serve as a confirmation that the market is not just experiencing a temporary dip, but is likely to continue its prior downward move. In other words, instead of chasing the decline, waiting patiently for the market to develop more structure on the way down as it fully balances this spike, and then let me switch here to the 5-minute time frame, and then retrace into this imbalance area, provided a high probability setup, an entry point which aligned with the overall bearish momentum. Obviously, nothing in trading is ever certain, but I thought this measured approach would allow me to manage the risks of this high probability trade more effectively, while at the same time still take advantage of the ongoing downward trend. That's why I went ahead and placed my short around the 247 level. And as you can see, after the fill, the market continued pushing lower, reaffirming the bias of the trade. By the way, guys, if you found this trade breakdown helpful, don't miss my next video, where I'll be discussing similar setup strategies to help you continue sharpening your trading edge. Alright gang, thanks for watching, and as always, hope to catch you all in the next one.